Bismillahirrahmanirrahim. This is Dr. Shahul Hamid again. This is the second part of the video on istisna, where we are going to explore the loss making situation where we have to reduce the WIP to the cash equivalent value. Now let us look at this problem here. This is it's actually a 4-year istisna contract. Okay. And the contract price initially is 200,000, but as you know, istisna prices cannot be altered. Then the initial cost was 150,000, so the expected profit is 200 minus 150 is 50,000. Okay. Now what happened is year 1 we incur a cost of 30,000, year 2 100, 130, year 3 150. But in year 3, the cost of the contract is expected to increase by additional 60,000, which I suppose will be incurred in year 4. So here we have columns for cost incurred, percentage completion, profit recognized. And here the balance sheet, and we have made out the income statement, alright, for year 1, 2, 3, 4. So what we are going to start now. So first let's calculate. Even if it's a loss-making contract, I urge you to start doing the work, because the first initial 1 or 2 years will be easy to do. All you have to do is take the percentage of completion. So we take the cost incurred in the first year, which is 30,000. We divide by the initial expected cost, which is the 150 here. So until we know that there is an increase, we use the initial expected cost. So it's 20,000. I put in a formula. Basically is 20% point this figure here multiplied by the expected profit of 50,000 is 20% of 50 is 10,000. So here we do the formula again. So here the second year we already incurred 100, okay, and the total is still 150. All right, so we get 67% completion, okay, for that particular year. All right, and we recognize a profit of 33%. Okay. All right, so here what we are going to do is we are going to put the actual incurred cost here in the work in progress, and the profit is 10,000. So at the end of the year we have 40,000 in the balance sheet, which is going to go here in the balance sheet. You see that? Okay. Now next year we got 100,000 incurred, 67%, 33,000. So now we are going to bring that down. So the cost incurred in the second year is 100. So we are going to add that to the istisna work in progress account. All right, and the profit is 33,000. So I already linked this formula here. Okay, so in the formula here is actually equal to this one, which is 67% of 50,000, 33,000. Okay. Now, let's year 3 we have a situation where we have 50,000 cost, so we're going to add that 50,000 here, all right, to the work in progress account. Now, here we shouldn't use the percentage of completion anymore, because we are informed that in year 3 the cost of the contract is expected to increase by additional 60,000. So if you put in another 60,000 to the cost of 150, the initial cost of 150, you are going to get a total cost of the contract of 210,000, but the contract price is only 200,000. So 200 minus 210,000, you are going to get a loss of 10,000 at the final outcome of the contract. So what do we do in this case? What we do is we have to go back to the accounting standard for inventory valuation. So the WIP is like an inventory, and we are holding it. Okay, the construction is in progress. We are holding it in the balance sheet. Okay, so what we have to do? Let's finish the balance sheet first. Okay, so here the second year. Okay, sorry. Yeah, right. Sorry. Second year we are going to have this total at the end of the second year. Remember, the istisna work in progress is going to build up. It's going to accumulate. Okay. So 133 plus 40,000, 173. All right. Now in the third year, we are going to calculate the CEV. Now let's take this concept first. So inventory, according to the accounting standard, must be carried at lower of cost and net realizable value. What this means is, let's say we buy a book, and our book is an inventory. We are buying it at $100. We hope to sell it for more than $100 to make a profit. However, let's say after some time nobody bought this book. The selling price of the book currently is $80 only, and we got to deliver the book to somebody, and that will cost us $10 cost to sell here. All right. So we calculate something called net realizable value, which is the selling price now is 80. That okay, minus we have to incur another $10. So our there's some problem here. Let me take care of that. So actually our net realizable value is $70. Okay, it's $70. All right. So $80 selling price minus $10, we have to spend another $10. So basically we are going to make a net of $70 if we sell the book, which costs us $100. So now this cost, which is totally irrelevant now, because we bought it at 100, we only can manage 70. So we have to bring down the inventory. We haven't sold it yet, but we have to bring down the inventory from 100 to 70. This we can do by crediting the inventory account and debiting profit and loss by $30 to bring it down to 70. So we already recognize the loss even before we realize the loss. This is called the prudence concept in accounting. Now let's go to the case of this istisna. Okay. So what we have is, we have the istisna. Okay. We have now put in, along with the cost and the profit. And if we forget about the profit for the year 3, there is not going to be any more profit. We've taken too much already. So if we take the last year's cumulative WIP plus this year, we are going to. Okay, now our new revised profit is actually 200,000. Okay, all right, minus our new cost, which is the previous cost of 150 plus another $60,000, which is here. So $60,000, we are going to add the cost. Okay, so total giving 60 plus the 150 is 210. So with that, so what we are going to have is actually a position where we are going to make a loss of 10,000. Once we know we are going to make a loss, we have to reduce this istisna work in progress to the cash equivalent value. Now what is the cash equivalent value? Cash equivalent value, as I said, is we have to take, okay, all right, it's already here. Okay, so the cash equivalent value is, okay, let us calculate this again. All right, so we're going to have cash equivalent value, okay, of we start with the contract price. Okay, contract price minus, okay, all right, what is the new cost? The new cost is 210. Okay, we already calculated that just now. And then we have to deduct the what is we have incurred so far. So the cost we have incurred so far is the 3 years cost here, 3,150. So what I'm going to do is, I'm going to add this up. All right, this one and this one. So we're going to put 2 brackets there. So our new cash equivalent value is 170,000. Now we have to reduce this, all right, to 170. So what we are going to do is, okay, when we add this total is 223, all right. So we want to balance, carry it down, it's 170. This is what we are going to have. This means that if you take 223, okay, which is all the costs we have incurred so far plus the profit we have incurred, all right, we already recorded is 223, but we want to reduce it to 170. So we have to take off 53,333 from the istisna work in progress. So the journal entry for this is credit istisna work in progress and debit profit and loss account. All right. Once we've done that, we'll have 170 here. Okay. So what we are going to have here, okay, is actually 170. 170,000. Okay, 170,000 in at the end of year 3. Okay, so remember, when there is a loss making situation, calculate the CEV and replace the CEV in the work in progress. The balance, you have to reduce the balance to the CEV, and any difference you have to take it to the profit and loss account. Okay, now once we've done that, so there is no question of profit here. Okay, we don't calculate this at all, and there is no profit to be recognized. Actually, what we actually end up is we have to recognize a loss of 53,333 for the third year.